In video 1, we started to explore the concept of how candle ranges react from one another. But the highs and lows of candle ranges are not just lines on a chart, and that's what most traders miss. Those highs and lows represent money, and money means liquidity in trading. Liquidity is what fuels the next movement of price. So we're going to look at how candle range liquidity gives us additional confluence to take high probability swing trades. So to do that, I want to just touch on what makes CRT so effective. So the definition here is that candle range theory works because higher time frame candles collect liquidity at their highs and lows. So in the previous example, we talked about the open, high, close, and low of a candle. But the high and the low specifically represent the external range liquidity or money that sits at the external edges of candle ranges. What this means and why it's so important is that institutions hunt this liquidity because they want to fill the largest possible positions or orders in the market before price then shifts. So if you can spot where money is being hunted on the chart, position yourself correctly, you can stay on the right side of that hunt for liquidity. Now, to visualize this, previously we looked at the highs and lows of candles. So this is the entire candle range. And what we have essentially is liquidity building in the form of sell stops at the low of candles. And we have buy stops building at the liquidity at the high of the candle. So this is where the liquidity points from an external range perspective start to build. And this is why CRT is so effective. Because if you think about it, say for example, this is a closed candle and you see traders getting into positions within this weekly time frame. This is the type of thing that you're going to be seeing. You're going to actually be seeing new positions being opened in the market. Where are the stop losses building for those positions? Well, they're at the lows. So when we saw this initial shift in the creation of this candle, we saw an accumulation of orders building in the market with stop losses at this low. So if the previous slide didn't make sense, hopefully this does. When higher time frame candles form, they are creating liquidity, and the largest pools of liquidity sit at the extremes of candle ranges, so the highs and the lows. If you think about it then, when candles sweep below, so they break out below the lows of previous candles, what is actually happening there is institutions are driving price down so that they can stop or trigger those stops in the market to fill positions in order to then potentially take counter trend trades. So if we see this is a visual representation of a liquidity sweep where price is being driven into the liquidity at this low, stopping out anyone that is still long at this level. What it's also doing is it's attracting new breakout traders into the market, because at this point, traders think, okay, we're going lower, but actually we close inside, and then there are more stop losses building in these levels that price can then target. Or we get a break and close outside. In this case, this is a liquidity run, because what's happened is that, yes, there is liquidity at this level, but price is traded into it, it's taken the liquidity, but it's closed bearish. So it's not had enough of a reaction to close inside the range. So naturally, price will want to target lower to collect more liquidity before price reverses, or maybe it's going to continue. But this is the formations of understanding the relationship between candle ranges, and it's why CRT is so effective. So in reading candle range composition, we can effectively trade, because we don't want to take long trades until we see the objective of price completed, which means even if we think price is going to go long, we don't want to get into a long trade until we see this liquidity being swept. So if this pattern happened before this liquidity was taken, then we wouldn't have the right context to actually get into a long trade that is going to play out, because it's probably just manipulation where pattern traders think, oh, I've seen my setup, I need to go long. The actual objective of price hasn't been achieved. The liquidity at this low has not yet been swept or taken. So we're going to combine all of these methods, these ways of thinking, into effective swing trading. So candle range liquidations, this is so important because CRT works because higher time frame liquidations act as the fuel for profitable swing trades. So let's actually look at this on the chart. Same example right here. So we explained this in the last video, but price broke below its previous candle range. So we had a bullish candle range. This is a 2-week candle range, and we're looking at 12-hour price action. So we had a bullish candle right here, and this is essentially the level at this low where sell stops are building. Because if you think about it, as soon as we start to get this reaction in the market, traders are taking longs. They're placing their buy orders in this exact way to target higher. Maybe they want a 2R. So you can see money is starting to build at this level. This trade is not going to play out because in creating this 2-week candle range, we have created liquidity at this candle's low. So price then reverses aggressively. We see new order block, we trade in, we try and go higher. This is enticing even more longs into the market at this level here. So the next evolution would be that we see maybe new traders entering from this order block right here. And again, they're looking for longs, maybe to target this high. And what happens? Price just dumps on them. It's aggressive. We even entice more liquidity into the market, but eventually sell off extremely hard into this low, and actually this low as well. Then we get a retracement into this internal range liquidity, which we'll touch on later. We see price selling off again. So this is how liquidity is then building again, because I talked about breakout traders, but the next thing that price is now trying to manufacture is new entrants into the market for shorts. This didn't play out. We've seen a structure shift. They're not seeing that we're sweeping this liquidity. They're just pattern trading this, whereby we have an order block here. So this is the last buy before the sell. So they'll mark that as an order block, and then they're looking to get in short from the order block. In isolation, it sounds like, yeah, this is a good trade. This could play off. But no, that is not what price is trying to do. It's liquidating or sweeping the external range liquidity at these lows, and then price shifts, trapping anyone that gets involved here and probably stopping them out. And then we have the true intention of price, which is to reverse, and we get then very clean price action to the high that we discussed. And where is this high? It's at the next point of external range liquidity. So this is the liquidity that sits at the high of this candle range. So we see candle range created, it finished printing. We had liquidity at the low, liquidity at the high. Price manufactures new longs, then new shorts into the market, and traps anyone looking to break out lower, then reverses. Once it's reached its objective, it then trades aggressively to the high. So what we are trying to do with CRT is understand the relationship between these higher time frame candles, truly understand what price is actually trying to do, and then staying on the right side. When you're on the right side, you can get a lot wrong and still be a very profitable trader. But this is what is creating the fuel for CRT, and this is why it's so effective. On the next video, we're going to look at accumulation, manipulation, distribution, and that's going to help us start to form proper trading targets.